Okay, in this video, we're going to go through lease accounting basics. We'll start with some lease basics, and then we'll go through the journal entries of how to account for leases, and finally, we'll take a big picture overview of lease accounting. First, let's talk about what is a lease. A lease is a contractual arrangement between two parties. The lessee makes a series of payments to the lessor in exchange for the right to use an asset for a specified period of time. I've been a party to many leases over the course of my life, and companies engage in lots of leases for the types of assets that they use. One example is the airliner Southwest Airlines. Many of the airplanes that they use are leased. Here I'm showing you an excerpt from their 10K where they talk about their aircraft. And as you can see down at the bottom of this item 2 aircraft summary, they've got 770 aircraft that they use. 676 of them are owned by the company, and 94 of them are leased. And leased just means they don't own it, okay? They are using someone else's airplane and making payments for the right to use that asset. So let's talk about the arrangement that Southwest is engaged in. So here we have Southwest, the company, on one side, and the bank or some other financial institution that owns an airplane on the other side. Southwest writes a contract. They want to be able to use this airplane, and they agree to make payments while they're using the airplane. The financial institution owns the airplane. So what do these two parties do? They switch. Now, Southwest has the right to use this airplane, and the financial institution has the right to receive payments from Southwest while Southwest is using the airplane. There are two types of leases for accounting purposes: finance leases and operating leases. We're not going to go through these criteria in detail. These criteria tell companies, the accounting department of companies, whether to account for the lease as a finance lease or as an operating lease. And depending on which one you use, different journal entries are involved. And so the accounting department will go through these criteria. If any of them are met, the company will account for the lease as a finance lease. If none of these criteria are met, the company will account for the lease as an operating lease. Now, the accounting treatment of these two types of leases used to be significantly different prior to 2019. After 2019, the accounting treatment for these two different categories of leases has converged significantly. And so now it doesn't matter too much which type of lease you have. They're accounted for very similarly. But we'll talk about the differences in this video. This slide is an overview of the journal entries for the two different types of leases. There's finance leases and operating leases. There's also two types of journal entries. Number one here is the initial measurement. So at the inception of the lease, when the airplane comes to us and we agree to make payments, at the inception of the lease, what journal entry is recorded by Southwest? That's part one. And then there's subsequent measurement. As the years go by during the lease term, what journal entries are recorded? So we'll start with finance leases, so I'll reveal everything here. At the inception of the lease, the initial measurement, the company receives the right to use the airplane in exchange for the agreement to make payments. The company will record an asset on their balance sheet for that right to use the airplane, and a liability which represents the obligation to make future lease payments. And that amount will be equal to the present value of the future minimum lease payments using an effective interest rate as the discount rate. Well, now the company's got this asset and this liability on their balance sheet that they need to deal with. So how do they deal with the asset and the liability? How do they account for it subsequently? Well, step one is they depreciate the asset. And this can be using whatever depreciation method they use, typically the straight line depreciation method. They'll straight line depreciate the asset to zero book value over the term of the lease. How do they deal with the liability? They deal with it similar to a bond with a face value of zero. And so they will amortize the book value of that liability towards zero using the effective interest method over the lease term. Each time they make a cash payment, that cash payment will be partially interest and partially paying down the principal of the obligation. The amount that is allocated to interest cost will be on the cash flow statement as an operating cash flow, and the amount that pays down the principal will be in the financing section of the cash flow statement. Next, for operating leases, the initial measurement is exactly the same. At the inception of the lease, the company will create an asset, which represents the right to use the asset, and the liability, which represents the obligation to make payments. But the accounting is a bit simpler for operating leases. Whatever cash payment the company makes, the straight line cash payment over the life of the lease, that will just be recorded as rental expense in each year's income statement, along with the cash payment that they're making because of the lease agreement. At the same time, though, they need to eliminate the asset and liability from the balance sheet over the lease term, and so they'll do that using the effective interest method. So this is an overview of the journal entries, but I think it's easier if we do a concrete example, so let's do that. So let's imagine a lease between Southwest Airlines and a bank. The start date of the lease is January 1st, 2019. It's got a 3-year term, 2019, 2020, 2021. And so we stop being able to use the airplane at the end of 2021. How are we going to pay for it? Well, we only have to make $100 payments at the end of each year during the lease term. So we'll make 3 $100 payments. The effective interest rate in the lease will be given, and it's a 10% effective interest rate to make things simple. So here's what the company will do at the inception of the lease. It's January 1st, 2019. Southwest signs the lease and obtains the right to use the airplane. The accounting department will create a schedule of future payments, minimum lease payments that are expected to make under the lease. It's $100 each year for the next 3 years. What the accounting department will do is discount those payments using the effective interest rate. So they'll discount the first payment by taking the future value of 100, dividing it by 1 plus the effective interest rate, raised to the power of 1, since that first payment is 1 year away, and that has a present value of $91. The second payment divided by 1 plus the effective interest rate raised to the power of 2, since it's 2 years away. The present value of that payment is $83. And the third payment is $100 future value divided by 1 plus the effective interest rate raised to the power of 3, since it's 3 years away. The present value of that payment is $75. As you can see, as the payments get farther into the future, they get less painful in terms of present value. I would rather pay $100 3 years from now than $100 next year. And that's why the $100 3 years from now isn't as big in present value terms as $100 1 year from now. So the accounting department has taken the schedule of future payments, discounted it to today using the effective interest rate, and the sum of those payments is a $249 present value of the future minimum lease payments, $249. So at the inception of the lease, the initial measurement is to create an asset and a liability for that value. And so the journal entry is to debit a leased asset for $249 and credit a lease liability for $249. Now, I named it lease asset here in the journal entry. Companies will use slightly different naming for these accounts, and particularly they tend to call an operating leased asset a right of use asset on the balance sheet. So if it's an operating lease, the label on this account will say right of use asset. If it's a finance lease, the label on this journal entry will actually just say PP&E. Okay, they'll just include it with their PP&E balance, typically. That's the initial measurement, January 1st, 2019. Now let's go to December 31st, 2019. Southwest makes the first lease payment of $100. And first, let's talk about the finance lease. In this first box, we're going to talk about the PP&E. So what are we going to do with that the asset that we created? We created a $249 asset. It's a 3-year lease term. We're going to straight line depreciate that asset to 0 over the 3-year lease term. And so we record depreciation expense equal to 1/3 of the value of that asset, which is $83. We depreciate $83 as depreciation expense, and we record a credit to accumulated depreciation, which is a contra asset account. It goes against the $249 asset minus the $83 of accumulated depreciation, and now we have a asset that is reducing in value over time. Okay, this year by $83 on a straight line basis. That's how we handle the asset in the first year. How about the liability? Well, the liability, we treat it like a bond, so it's going to be similar to bond accounting. First, let's record interest expense. So here's our lease obligation T account. It's got an opening balance of $249, and that's a credit balance. We're going to take that credit balance of $249, the beginning balance, and multiply it by the effective interest rate of 10%. $249 times 10% is $25, and that's what we'll record as a debit to interest expense on the first year's income statement. Now, at the same time we're recording interest expense, we're also making this cash payment, aren't we? We're making a $100 cash payment to the financial institution that leased us the asset. So we're going to credit cash for that cash payment, for the cash going out the door. And if you'll recall, in accounting for bonds, the difference between the cash payment and the interest expense amortizes the book value of the liability towards its face value. In this case, leases typically just have a face value of 0. So the difference between the cash payment and the interest expense is $75. We need a debit to balance this journal entry, so we'll debit the lease liability for $75. And that's amortizing the lease liability down. Now watch me post this $75 to the T account. The $75 gets posted as a debit to the T account. And now the lease obligation has a new balance of $174, so it's amortizing down towards 0, okay? That's the end of the first year for a finance lease. Now let's talk about the operating lease, okay? First, we're going to recognize rent expense, okay? So this is just the straight line cash payment as part of the lease. We'll debit rent expense for that $100 and we'll credit cash for that $100. It's a bit simpler. The next part is, well, we've got this asset and liability on our balance sheet and they need to go to 0 by the end of the lease term, okay? They need to be gone off the balance sheet by the end of the lease term. So how do we accomplish that with an operating lease? We amortize them both at the same rate, and we amortize them at the effective interest method rate. So you'll see this $75 here, which we computed as the difference between the interest expense and the cash payment. That is the rate at which we are amortizing the lease liability and the asset. So we debit the lease liability to reduce it by 75, and we credit the asset account to reduce it by 75. Now let's go to the next year. In the next year, we'll make the same journal entries, okay? We're going to straight line depreciate the asset again, another $83. Now we're going to record interest expense, but we've got a new beginning book value. Our new beginning book value is $174. So we'll take that 174 times 10%, and now we have interest expense of $17. We've got a cash payment of $100. The difference between 17 and 100 is 83. And so we'll amortize the lease liability by 83. I'll post that 83 to the T account. And now we have a new ending balance in our T account of $91 left on that obligation. Now I'm not showing you the asset T account, but that one is amortizing at a different rate. I'll show you a slide in the future which shows you it's still going to 0. It's just not an irregular rate. You see how the rate of change towards 0 is irregular for the lease obligation. The asset is going towards 0 at a straight line rate. Now for the operating lease, this is going to look pretty familiar. We record rent expense of $100 as we make the cash payment of $100. And we amortize the lease liability and the leased asset at the same effective interest method rate that we used above, okay, $83. And in the final year for the finance lease, we're going to make our final depreciation expense of $83. Now the asset is depreciated to 0. And we'll make our final payment, okay? So we'll record interest expense. We've got a new opening book value of 91. We'll take 91 times 10%, which is $9. We'll make our $100 cash payment. The difference is 91. So we'll debit the lease liability by $91. When we do that, when we post it, guess what? Now we have a lease liability of 0. We've amortized it to 0 over the lease term. And the finance lease accounting is over. Now let's end the operating lease accounting. Let's make our final rent payment of $100, debit rent expense, credit cash, and we'll amortize the rest of the asset and liability to 0 using the same effective interest rate method that we used for a finance lease. Okay? Now we're going to zoom in on this overall accounting method. Okay, so here we have all 3 years of accounting for a finance lease. So this is just the finance lease. And I made a spreadsheet here to show you all the journal entries and the presentation on the statement of cash flows in accounting for a finance lease. Now, some of the numbers in this spreadsheet are positive, some of the numbers are negative. If it's a positive number, that means it's a debit, and it's a negative number, it's got parentheses around it, it means it's a credit. Okay, so let's just go through the accounting for a finance lease. I'm going to start with the inception journal entry right here. At the inception of the lease, remember the company created an asset and a liability account. So there's the debit in the asset account and the credit in the liability account. And that was just to reflect the idea that the company now had the right to use an asset for 3 years and the obligation to make lease payments for 3 years. So that was the inception of the lease. Now I'm going to kind of go through account by account, okay? So let's start with the cash account, okay? So at the inception of the lease, the company didn't pay any cash, but in the first year, the company had to make a $100 cash payment. In the second year and in the third year, they made $100 cash payments. So if you put all 3 years together, they made $300 of cash payments on this lease, okay? That's the cash account over the course of this finance lease. Now let's talk about the PP&E account. Remember, we created this PP&E asset to reflect the notion that we had the right to use an airplane for 3 years. What we did with this asset is we straight line depreciated it to 0 over 3 years. So we recorded $83 of accumulated depreciation each year. 83 additional dollars of accumulated depreciation each year. And so here, these columns here show you what is the balance after each year. So after year 1, which is right here, the asset decreased by $83 and now it's at $166. At year 2, which is right here, decreased by another $83 and now it's only worth $83. And after the third year, which is right here, it decreased the final $83 and it's now depreciated to 0. So that asset straight line depreciated to 0. The lease liability, on the other hand, still went to 0, as you can see here, but it went using the effective interest method. So the credit balance of $249 decreased by posting a debit to it, okay? So it decreased by 75 in the first year, 83 in the second year, and 91 in the third year. Decreased at an increasing rate. So the liability and the asset go to 0 over the lease term. On the income statement now, let's talk about depreciation expense. It's straight line depreciation expense, $83 each year. And so on our income statement, we'll have a flat depreciation expense each year. Interest expense, on the other hand, is not flat. It's front-loaded. The company recorded $25 of interest expense in year 1, $17 of interest expense in year 2, and only $9 of interest expense in year 3. If you talk about totals over the 3 years, the company depreciated the asset, which had a value of $249, and the interest cost is $51, okay? So the original present value of the asset was $249, and the interest cost that we allocated to leasing the asset is $51 over the life of the lease. Total expense is $300, which of course matches up with the amount of cash we paid. Finally, the cash flow presentation. The interest expense portion of the cash payment each year goes into the operating section of the cash flow statement. And the remainder, which is the cash payment minus interest expense, is a financing cash outflow. And that is repeated in year 2 and year 3. But if you sum up the total cash flows together, the total cash outflows were $300 of a cash outflow, okay? So that's just an overview of accounting for a finance lease. Now we'll just look at the operating lease. At the inception, it's the same journal entries. We created an asset and a liability for $249. We made $100. So now looking at the cash account, we made the same $100 payments over the 3 years. The difference is we're now no longer straight line depreciating the PP&E account. We are doing the same thing we do for the liability account, we do for the PP&E account. So they both reduce by 75 in year 1. They reduce by 83 in year 2 and 91 in year 3. They both end up at 0 after 3 years. The income statement presentation now is flat. Remember how interest expense was front-loaded on the finance lease? Well, for an operating lease, the expense is flat. It's $100 straight line expense over 3 years. So you have to take that into account. If companies are having an operating lease, they're going to have flat expenses over the term of the lease. If they have a finance lease, those expenses are going to be front-loaded due to the interest expense. And finally, on the statement of cash flows, that entire rental payment we treat as an operating cash flow. And so there's no financing cash flow for an operating lease. Okay, so that's just the overview of what the journal entries look like when you look at them all at one time. So that's it. We went through basic accounting for leases. We learned that when a company leases an asset, they recognize an asset on the balance sheet to reflect the value of the right to use it. They recognize a liability on the balance sheet that reflects the obligation to make future lease payments. And they have to reduce those asset and liability accounts to zero over the lease term. And they do that with expenses, but the expenses recognized on the income statement over the lease term will differ, depending on whether the company is accounting for the lease as a finance or an operating lease.